We usually think of money as something with a number attached to it. $10, $100, $1 million. But there is another price, a price that determines what it costs to borrow money, interest. And that price can influence almost everything: mortgages, business loans, credit cards, investments, government borrowing, and financial markets. Somewhere inside the financial system, there is an institution whose decisions can influence that price: the central bank. It does not decide how much your coffee costs. It does not tell a company what to build. It does not choose which stock you should buy. Yet, when it changes the cost of money, the entire economy can respond. That is the strange power of central banking. It operates at the foundation, while the consequences appear everywhere.
A commercial bank serves customers. It accepts deposits, makes loans, provides payment services, and manages financial accounts. A central bank operates at a different level. It sits at the core of the banking system. Commercial banks maintain accounts with the central bank. They interact with the central bank's settlement infrastructure. And the central bank can influence the conditions under which banks obtain and hold reserves. This creates a hierarchy, not necessarily a hierarchy of ownership, but a hierarchy of infrastructure. Commercial banks connect businesses and households to the financial system. The central bank helps provide the foundation on which those banks operate. This is why central banks are sometimes described as the banker's bank. But that description still does not capture their full role, because central banks are also responsible for something much larger: the stability of the monetary system.
Imagine the economy as an enormous machine. Millions of businesses, hundreds of millions of households, banks, investors, governments, and financial institutions, all making decisions. Should we borrow? Should we invest? Should we save? Should we expand? Should we buy a house? Should we hire more people? All of these decisions depend partly on the cost of money. That is why interest rates matter. When rates rise, borrowing generally becomes more expensive. Some businesses delay investment. Some households reconsider large purchases. Financial conditions tighten. When rates fall, the opposite pressure can emerge. Borrowing can become cheaper. Investment can become more attractive. Economic activity can receive support. A central bank, therefore, does not need to control every decision. It only needs to influence one of the most important variables in the system, the cost of money, and millions of independent decisions can respond.
A central bank changes its policy rate. That does not mean every loan in the economy instantly changes by the same amount. The financial system is more complicated than that. But the signal travels. Banks adjust their funding conditions. Bond yields respond. Markets reprice expectations. Lenders reconsider the rates they offer. Businesses reconsider financing decisions. Households reconsider borrowing. And investors reconsider where capital should go. One decision creates thousands of reactions. Some happen immediately. Others take months. Some are obvious. Others happen deep inside financial markets. This is why monetary policy is often described as a transmission mechanism. The central bank does not directly control the entire economy. It sends a signal into the financial system. The financial system carries that signal outward, and eventually, the real economy responds.
One of the biggest responsibilities of modern central banking is price stability. Inflation means the general level of prices is rising over time. A little inflation can exist within a healthy economy, but when inflation becomes persistent or unstable, it creates problems. Households lose purchasing power. Businesses struggle to predict future costs. Contracts become harder to price. Investment decisions become more uncertain, and confidence can weaken. Central banks therefore watch inflation closely. When inflation becomes too strong, they may tighten financial conditions. Higher interest rates can reduce demand. Borrowing can become more expensive. Saving can become relatively more attractive, and economic activity can cool. The objective is not simply to make the economy slower. It is to bring demand and supply into better balance without destroying the system supporting them. That is the difficult part. Central banking is not about pressing one button. It is about steering a system with enormous momentum.
There is a problem. If monetary policy becomes too restrictive, the consequences can go too far. Businesses may struggle to refinance debt. Households may reduce spending. Investment may weaken. Financial markets may become stressed. And heavily indebted institutions can become vulnerable. This creates a delicate balance. Move too slowly, and inflation can become entrenched. Move too aggressively, and economic activity can deteriorate. Central banks therefore operate under uncertainty. They never have perfect information. They do not know exactly how consumers will respond. They do not know exactly how businesses will react, and they cannot perfectly predict global events. A rate decision made today may influence the economy many months later. The central bank is therefore always looking forward, trying to steer a machine whose response arrives with a delay.
There is another role that becomes visible when things go wrong: liquidity. A bank can be fundamentally healthy and still face a sudden shortage of cash. Why? Because banking depends heavily on confidence. If depositors suddenly want their money, a bank may need liquidity immediately. But much of what a bank owns may be tied up in loans or investments. Those assets cannot always be converted into cash instantly. This is where the central bank can become a lender of last resort. In extreme circumstances, it can provide liquidity to parts of the financial system. The objective is not to rescue every bad decision. It is to prevent a temporary liquidity problem from becoming a systemic collapse. Because financial systems are interconnected, one institution's failure can affect another, and another, and another. Sometimes, the most important thing a central bank provides is not money, it is time. Time for the system to stabilize. Central banks do not only influence markets through what they do, they also influence markets through what they say. A single sentence can change expectations. If investors believe interest rates will remain high, bond yields can adjust, currencies can move, stocks can reprice, businesses can change their plans, and financial institutions can alter their strategies. This is why central bank communication has become so important. Markets are constantly trying to predict the future. What will inflation look like? Will rates rise? Will they fall? Will the economy slow? Will the central bank intervene? Expectations become part of the financial system, and once expectations move, money can move with them. This creates a remarkable situation. A central bank does not always need to physically move money to influence where capital goes. Sometimes, information is enough.
Modern economies are deeply connected. Capital moves across borders. Companies operate internationally. Banks lend across countries. Investors hold foreign assets. And currencies trade continuously. That means one central bank's decisions can affect another economy. If interest rates rise in one major economy, capital may become more attractive there. Currencies can respond, investment flows can change. Other central banks may need to consider their own policies. This creates a global monetary network. No central bank operates in complete isolation. Each one watches the others. The Federal Reserve, the European Central Bank, the Bank of Japan, the Bank of England, and many others, all operate within their own economies, but their decisions interact through global capital markets. The world, therefore, has something resembling a decentralized monetary system. Different institutions, different mandates, different economies, but one interconnected financial network.
A central bank does not control the economy. It cannot control every business, every household, every market, every price, and every financial decision. But it can influence one of the most important foundations beneath them, the conditions under which money and credit flow. That is why central banking matters. Interest rates affect borrowing. Liquidity affects stability. Expectations affect markets. And confidence affects everything. The central bank sits at a strange position in modern civilization. It is not the economy. It is not the market. And it is not the banking system. But it is deeply connected to all three. Its decisions travel through financial infrastructure, into businesses, into households, into investments, and eventually into the real economy. The most powerful part may be the part nobody sees. A number changes, a statement is released, a policy shifts, and millions of decisions begin changing around it. That is the architecture of modern power, because sometimes the institution with the greatest influence is not the one producing the most. It is the one influencing the conditions under which everything else operates. NEXNET, the architecture of modern civilization.